Well, Australia's central bank hiked interest rates by a quarter point. That was a surprise to markets as it kicked off a string of central bank meetings this week. We're going to hear from the Federal Reserve's interest rate decision tomorrow, and the European Central Bank is up on Thursday. Joining us now to talk all things Fed and, of course, what it means for the markets is Cannacord Genuity Chief Market Strategist Tony Dwyer. Tony, good to see you. Thanks for being here.
Thanks for having me.
It doesn't feel like the needle has really moved on what the Fed is going to do tomorrow, but there's a lot of chatter about sort of the framing that Jay Powell and company are going to give us. So what are you thinking, and how are you thinking it'll affect the markets?
I mean, truly, most indicators are so neutral that if you gave me what he would say right now, Julie, I'm not sure I could answer you what's going to happen in the market tomorrow. I just think, what we found is so much intraday volatility is just suggesting nobody knows what to do, and it's a real lack of liquidity. So lesser volume can have an outsized impact on the markets. Trying to game this stuff, I think I'm not very good at it. What I'm pretty good at, I think, is the impact of it over the intermediate term. And the Fed is still raising rates in a historic way into a generationally levered system with significant tightness in financial conditions, tightening financial conditions. That's usually not a great thing.
Tony, people still come to you for a game plan during this type of environment, even though. So what is the game plan that you've been employing? You said in your notes to us a light and tight playbook might actually prevail here. What would that entail?
So it means, listen, we're 15 months into this, right? I'm getting sick of being negative. And it comes from, my reputation isn't that way. It's the other side. But the whole point is it's about the money. Right. And the money, you've got to find a reason or a way to have new money to grow again next year or into the future. So our plan has been not to get so negative. I'm pretty negative defensive from an economic standpoint. I do think we're going to have another move back toward the low. But if you're positioned overly negative, it's very hard to try and take a more aggressive approach there. Like I said, we're 15 months into this. So light and tight means have a little extra cash in your portfolio and don't get overly defensive from a sector positioning. Remember, we advise institutional clients here in the U.S. So for those that can't have cash, I just don't want to be overly defensive because so many areas have already taken kind of a beating.
And Tony, I've heard some chatter lately that if you're in cash or if you're in fixed income generally for that matter, that it's kind of as good as it's going to get in terms of yields and in terms of what you're getting in terms of returns on that cash. Do you think that's true?
You've probably seen the peak in rates, Julie. Ultimately, let's talk about the valuation of stocks versus bonds. So if you look at the earnings yield, and for the viewers that aren't familiar with that term, an earnings yield is the reverse of a PE. So I'm using $210 a share for 2023 earnings. So if you take the earnings versus the S&P 500, you're at about a 5% earnings yield. You're at a little over a 5% yield in the 3-month or the 6-month T-bills. So the point is you're not getting paid a lot to take a guess at what's going to happen with the Fed tomorrow. And that, again, is our game plan. I don't want to bet on it, guys. I don't like to bet at all. I certainly don't like to do it with your money. So I would rather just get the 5% that I can get, which is the same as the earnings yield for the S&P 500, until I get a higher conviction. I think the mistake that so many of us in this business make is we come out with this emphatic opinion like we actually know what's going on. And then when it goes against us because the conviction level wasn't really high and wasn't based on data, we flip-flop. And I really, really have learned my lesson over the last 30 years to not do that. So I'm gonna heed that lesson and just wait for a better directional move, which can only come from a sharp reduction in the Fed funds rate.
And what about earnings? Do earnings do anything for a directional move from your perspective here?
Not really. I mean, look at it this way. Earnings have come in way better than expected. And people would say, wow, look at how great the market's held up. But then I got to define, Brad, which market. Russell 2000 on a relative basis to the S&P 500 is literally back to the lows of March of 2020. So the idea that this has been this broad advance like we saw in January, which we did, it just isn't correct. So I don't even know that the market knows how to handle earnings. Ultimately, when you put away all the quant programs and algorithms and formulas that folks like me have, it comes down to money. So you've got tightening financial conditions, which is the real story, I think, of the regional banks versus systemic risk. You've got a Fed that is still raising rates and is likely to stay higher for longer, according to what they're telling us anyway, which means you're not going to uninvert the yield curve. I don't know if that's a word, uninvert the yield curve
We'll take it.
for some time, which means, and you're also at full employment. So where are you going to get that extra money for growth? And that's the challenge I have at becoming bullish too early.
So, sort of to ask that question a different way, of those different factors, what do you need to see to get you more bullish? Which of those things do you think is most likely to provide some clarity first?
Now you could get a bounce. Let's say the Fed suggests that they might ease by the end of the year. That could that create a bounce in the market? Could. There's only one thing, Julie, that's going to really get me sustainably bullish, like my reputation has been over the years, and that is when you have a positive slope in the yield curve, which incents lending. Why did we? So many people. I answer the question, why does the market bottom in a recession when the data is the worst? And the answer is that bad data creates a sharp reduction in the Fed funds rate. It steepens the yield curve, which means short-term rates are well below long-term rates, which incents banks and lending institutions to lend. We're in the opposite situation right now. So it's really that opening, that visibility into forward-looking money indicators improving through a steeper yield curve really is the only thing.
Our thanks to Tony Dwyer, Cannacord Genuity, Chief Market Strategist. Tony, great to speak with you here this morning. Thanks so much.
Great to be with you. Thank you.